Hello, everyone. I think we can give us a start. It's 1 sharp, and then yes, we have a busy schedule ahead. Distinguished invitees and ladies and gentlemen, it's a pleasure to have everyone in the room and hopefully online for this interesting discussion and or development. Financing for development dialogues, evidence on action. The objective here is really to put academia at the center also of financing for development issues and to bring all the discussions from today with academia, think tanks ahead of the Financing for Development conference in Sevilla in 2025. My name is Samuel Plake. I'm an associate expert at UNDESA in the Financing for Sustainable Development Office. Yes, the objective of this session is to talk about financing resilience prosperity for SIDS. We have Dr. Emily Wilkinson as the moderator for this session. I'll invite everyone to make sure that we finish on time. But looking forward, and I'll let Emily introduce the rest of the panelists.
Thank you very much, and we'll do our best to finish on time. Welcome, everyone. Thank you very much for coming to this session, which I hope you all find enjoyable and enlightening. My name is Emily Wilkinson. I'm a Principal Research Fellow at ODI Global, a think tank based in the UK. I'm also Director of the Resilient and Sustainable Islands Initiative, which is a global scientific advisory network for small island developing states. And I'm an advisor to AOSIS, the Alliance for Small Island States. I will introduce my colleagues in a moment. I just wanted to provide a little bit of sort of background very briefly to sort of set up the panel discussion and just to sort of reflect on the elements paper and where sort of SIDS are situated within that. So we are all, I'm sure, intensely aware that SIDS face unique structural vulnerabilities and capacity constraints, which nominally, I would say, recognised by the international community and very lightly referenced in the elements paper. But I think what we want to do with this panel is to demonstrate that they need to be further demarcated and that specific reforms are going to be needed in the international financing architecture to ensure that it delivers for SIDS. So we're going to get to that and what some of those reforms are. The panel will highlight the specific challenges that SIDS face in their engagement with international financial institutions and the system. There'll be 5 presentations, hopefully time for a Q&A. And the panelists are going to be talking about SIDS structural vulnerabilities, how these are recognised or not in the international development cooperation and system. We're going to be talking about challenges in mobilising finance domestically and how international tax regulations impact on SIDS. And we're going to be talking about the costs of borrowing, climate shocks, and narrowing fiscal space in SIDS, and a sort of hint there that the sort of debt sustainability issues are not due to irresponsible behaviour, and we'll hear a bit more about that. And then challenges in accessing climate finance and some of the bias in international funds. So each presenter is going to highlight what SIDS are doing to overcome barriers created by the international system, but where reforms are needed to assist them to do this. But before we get to the presentations, I just want to ask my colleague Gail Hurley, development finance expert and Resi affiliate, to tell us a little bit about Addis Ababa Action Agenda and what it did or didn't deliver for SIDS. Thanks, Gail.
Thank you, Emily, and a warm welcome to everyone today. Thank you for your interest in the sustainable development in SIDS. I'll be super brief here, but just to say that the special development situation of SIDS was recognised in the Addis Ababa Action Agenda, and it called for tailored responses for SIDS to increase financial resources for SIDS, capacity building for SIDS, technical transfer for SIDS to support them to achieve sustainable development. Although not specifically related to SIDS, the agenda also made reference to the Sendai framework for disaster risk reduction and called for a scale-up in support for SIDS and other countries in disaster risk reduction, resilience building measures. And it also talked about the importance of achieving a better balance between climate adaptation, mitigation financing, which is also something that's part of the UNFCCC discussions. So there were a few things in there for SIDS, but it was all very general. And I think since then, unfortunately, I would say the situation has become much harder and more challenging for SIDS. I mean, on the one hand, since then there has been some progress. We've seen commitments, for example, from the Green Climate Fund to scale up financing for SIDS. Other international climate funds do the same. Agreement for the New Loss and Damage Fund. We've seen a plethora of ocean-related, blue economy-related initiatives launched, innovative finance modalities that purport to close the ocean financing gap for SIDS from both public and private sectors. But I would say all of these have fundamentally failed to move the needle on financing for SIDS. And yet the costs of recurrent crises and shocks has only become more expensive for them in a context of rising debt and so on. So I think there's definitely an opportunity within the FfD4 outcome document to be more ambitious when it comes to SIDS and recognising their specific development challenges, and be perhaps a little bit more concrete about what measures can be on the table to support them. And I think today we'll share in our research some of the suggestions that we have for measures which can be tabled within the FfD4 negotiations. So I'll leave it there for now and look forward to hearing from my colleagues.
Thank you very much, Gail. Okay, we're going to turn first to Dr. Matt Bishop, who's online in the UK, in the north of England, senior lecturer at Sheffield University and a co-director of RESI. I'll control the slides from here, Matt, so just let me know when you want me to move on. Over to you.
Okay, great. Can you hear me okay? Can you hear me?
Yes, we can hear you.
Oh, good. That's a relief. Okay, so I'm going to talk very briefly about the MVI, the Multidimensional Vulnerability Index, where we've been, how we've got there, and where we might be going. And in some respects, this is going to set the scene a little bit for the rest of the conversation in the room this afternoon. So first slide, please, Emily. I think it's important when we think about kind of the MVI and what it represents for SIDS, is that it's part of this kind of never-ending search for special and differential treatment. And we sometimes don't ever reflect on this kind of broader long-term process. But ever since many small island developing states became independent, and certainly since the establishment of their own UN process with the Barbados Programme of Action, there's been this ongoing attempt to make real their special case for sustainable development. But they have this formal UN-mandated special case for sustainable development, which, in my view, implies inherently that they should receive some kind of special and differential treatment. If you're a special case, then you require something special as a consequence of that. And this sort of demand for special and differential treatment is predicated on the recognition of their acute vulnerability and, more broadly, their capacity constraints, their insularity, their small size. And I'll come back to vulnerability in a moment, because I think the concept of vulnerability is really significant when we think about exactly why SIDS should receive special treatment. And it's often misunderstood, I think, in both the academic literature and some of the policy debate around the subject. But broadly speaking, SIDS have struggled to achieve special and differential treatment. In the trade arena, for example, which is where for much of the 1990s and 2000s they pursued claims for SDT, trade preferences were generally reserved for least developed countries, and there were a range of other reasons why SIDS struggled to achieve special and differential treatment, particularly beyond the kind of changes to the global trading system that happened with the end of preferences and so on for many of them. And as we know, many of them have been excluded from aid and concessional finance. And obviously this picture is quite mixed. I think other colleagues will talk about this a bit more in a moment. Some SIDS are LDCs as well and tend to get quite a significant amount of aid. Others don't, and in particular, many of the Caribbean countries don't really get any aid, and they really struggle to access concessional finance. And this is a huge problem because their vulnerability is intensifying. It's getting worse, as Gail just said. And I think this makes their special case even more compelling than it was in the 1990s and during the other programs of action where it's been reiterated. And this is because they are disproportionately exposed to intensifying shocks. So Hurricane Maria infamously did over 200% of GDP's worth of damage in Dominica in 2017. And we all saw the damage that was caused by Hurricane Beryl earlier this year, one of the most powerful hurricanes to hit the Caribbean at that point in the hurricane season in history. So things are getting worse. They're disproportionately exposed. And what that really means is that SIDS face shocks on a scale that larger countries, no matter how rich or poor they might be, simply don't have to face on quite the same scale. It is inconceivable to think of a crisis where a country like the UK would have to find 200 and something % of GDP to rebuild itself after a shock. Even the COVID-19 pandemic only cost the UK somewhere around 10% of GDP. So if you think about it in those terms, the effects of Hurricane Maria in Dominica were over 20 times as great. And this is a problem because the scale of damage and its suddenness, when combined with the fiscal constraints that many SIDS have, is leading to dramatically rising debt burdens in many cases. So it's no surprise, therefore, that Dominica is one of the countries that's struggling with the highest levels of debt on the planet. So the demand for a multidimensional vulnerability index was a kind of in recognition of this. There was a sense that finally SIDS were perhaps beginning to win the argument that the existing ways of calculating who's entitled to development finance specifically were no longer really fit for purpose, if ever they were. But the trade-off that they had to make here was with universality. So essentially, the MVI was something that's come to encompass all states because it's a UN agenda. And so in this sense, the kind of treatment that may emerge from it is not differential, right? So SIDS are not getting their own index that will give them special and differential treatment. It's an attempt to universalize the problem of vulnerability. And speaking, I think, kind of as an academic here, rather than somebody who's perhaps interested in the policy questions as well, I think this is a problem because arguably most, if not all, non-SIDS countries are not vulnerable. Lots of countries have huge problems in terms of development, but vulnerability isn't really about a lack of development. It's not about a country being poor or struggling to develop. It's about the level of exposure to shocks that can be suddenly and drastically damaging. And I think this is a real problem. If all countries are conceptualized in some way as vulnerable, that takes away that kind of uniqueness of the SIDS experience where they do face shocks on a scale that larger countries don't. And this is something we've reflected on a bit in the book there that you can see that Emily and other colleagues and myself have recently written, and that'll be published quite soon, where we kind of look at a lot of these debates. So anyway, the broad point to take from this first of 3 slides is that SIDS have continually searched for special and differential treatment. They've struggled to make it real. And the MVI really is a really important development forward, but it isn't one that is kind of attests to their special status. And there is no differentiality in it, really. So next slide, please, Emily. So that brings us to the politics of the MVI process itself. There's no question this is a huge success in the sense that it's the first time that SIDS have really won this argument and moved this agenda forward. But it was also quite a significant multilateral compromise. And a few things I want to say here are firstly that there are all manner of alternative existing frameworks that exist, and all of them have different strengths and weaknesses. And it's arguably the case that some of them capture much better the contours of SIDS vulnerability specifically than the MVI does, although, of course, the MVI is the one that's been accepted multilaterally. There were quite significant constraints placed on the high-level panel that established the MVI by both their mandate and the terms of reference that they were given. So there were quite a lot of compromises that they had to make. And SIDS themselves have faced a number of tensions in terms of their kind of advocacy of the MVI and some of the outcomes that it presages. So, for example, they've had to demonstrate, or they tried to demonstrate, that they're uniquely vulnerable, which personally I think they are, due to their distinctive characteristics, while almost implicitly leaving open the possibility that other states might be too. And there are questions here about the extent to which different groups of countries have an interest in sharing that kind of vision and that view. They've had to persuade the international community that the MVI is not solely about accessing greater shares of finance when everybody's worried about declining finance overall, while also kind of implicitly hoping that it achieves precisely that. There are questions around the way the criteria have been deployed and the data has been used in the MVI to ensure robustness. But at the same time, a number of the choices that the panel had to make haven't necessarily led to the best criteria for SIDS being implemented into the MVI. So the obvious one here is debt, for example. Debt doesn't feature quite as strongly as those of us that work closely on SIDS might think it should. And there's a whole set of other challenges around the kind of the purpose of official development assistance and by extension concessionality. So implicitly, the idea of ODA is that it should be temporary and designed explicitly to help facilitate graduation. But the problem that SIDS face is that their vulnerability is structural. Any small island developing state could unwittingly experience a shock that completely decimates its GDP for a very long and sustained period of time. So there are a whole set of other technical challenges as well with the MVI. I won't go into detail on these. We talk about them a bit in the policy brief that you can see there on the slide. But one of the technical challenges, for example, was that all of the data had to be available for all UN member states. And as we know, the data on small island developing states is especially patchy, particularly the data on the things that most clearly exhibit the extent of their vulnerability. This in turn influenced the choices of indicators. So there was a bit of debate and a bit of politics around that. And there's another problem is that, and this is, I guess, a kind of a more intellectual question, which is that vulnerability, which is a set of structural characteristics, was defined structurally, but so was resilience. And normally those of us that work on vulnerability and resilience more broadly would tend to see resilience as something that is about kind of agency and action and policy making. It isn't something that is a set of structural characteristics. So there were a series of technical compromises that had to be made. But there were also political challenges as well. So, for example, there was a tension around different SIDS having different interests in terms of the kind of finance that they wanted to unlock. So high-income SIDS in particular, who in many cases are some of the most vulnerable SIDS as well, wanted to unlock more finance, but there was significant resistance, and there remains significant resistance to the idea that countries that are perceived to be high-income on the basis of their GNI per capita should have access to more development finance. And there's a degree of skepticism more broadly around the application of the MVI. There's another issue around graduation and the way in which, if the MVI is used to ultimately deliver official development assistance, that raises questions about graduation and the extent to which countries would remain or come back onto the DAC list. And obviously there are plenty of SIDS who don't want to come back on to the DAC list. And there's a wider question here about the extent to which the MVI can be used to distribute aid money anyway, when there's no additional money in the system and the money that does exist is potentially under pressure. So there's a lot of politics here, and Emily and myself and other colleagues are working on a paper where we try to map some of this out in a bit more detail in a kind of reflective way. Final slide, please, Emily, and I'll only talk for a couple more minutes. So there's a question here about where we go next and where the MVI fits. The first thing to say, I guess, is that there is an ongoing dialogue taking place between AOSIS and the OECD DAC. And the unresolved question here really is the extent to which we're likely to see the questions of vulnerability complement GNI in odour disbursement or not. There's also a subsidiary question to that, which is the extent to which, even if we do start to see the MVI complement GNI in odour disbursement, are we actually also going to see SIDS lose out from that process? And it's not clear to me necessarily that some of the early technical work that's been done to kind of conceptualise levels of vulnerability necessarily correspond to what those of us that have worked on SIDS for a long time would intuitively anticipate. So it's not always what we would assume are the most vulnerable SIDS that necessarily are perceived as the most vulnerable under the MVI calculations. There's an ongoing tension between SIDS special case and the universality of the MVI. If many states are deemed to be vulnerable, what does this say about small size as the driving characteristic that generates vulnerability? And I think you could push that even further in a kind of academic intellectual sense, which is, well, does the concept of vulnerability itself start to break down in terms of its usefulness? And I could talk about that a lot more, but I won't now. The third is the technical questions that exist around the choices of indicators, and I've already talked about that, but the broader point to make here really is that some of them are not, I would suggest, about vulnerability per se. And obviously the HLP, through no fault of their own, had to make some quite big compromise decisions on this. And the broader point, and I think this hopefully sets the scene for the rest of the conversation, is that the financing crisis in SIDS is only getting worse. They require money on an unimaginable relative scale to deal with the challenges they face. And the justification for that, in terms of the scale of damage they face, where around 40% of all of their indebtedness is attributed to externally imposed climate shocks, is only getting stronger. And Emily and myself and Tomasi Blair and Simona Marinescu from the UN wrote this op-ed before the SIDS4 conference earlier this year, saying that essentially we need for SIDS a Marshall Plan, nothing less than a Marshall Plan. So I'll leave it there.
Thanks very much, Matt. And please, everyone, hold questions or any comments that you have on Matt's presentation to the end. We'll go through the other presentations and then have a Q&A session. So we're going to turn now to Alicia Nichols, who is a research fellow at the University of the West Indies in Barbados. Over to you.
Island of Barbados. So my presentation will be looking at domestic resource mobilization in SIDS, particularly from a Caribbean SIDS perspective. And of course, recognizing that SIDS challenges, as Matt very eloquently pointed out, show that domestic resource mobilization could only be an adjunct, not a replacement for external sources of financing. So as my co-panelist Gail eloquently mentioned, the Addis Ababa Action Agenda underscores the importance of scaling up domestic resource mobilization to help secure the financing necessary to achieve the SDGs. And central to this, of course, will be expanding the tax base and improving the tax to GDP ratios, reducing illicit financial flows, etc. So in the first part of my presentation, and bearing in mind that we only have 10 minutes, which I am thinking myself, I'm going to first talk about some of the issues with regard to Caribbean SIDS with respect to taxation, and then I'll speak, that will be the backdrop against which I will make recommendations for the international community with regard to action. So with regard to tax revenue, as you could see, as a percentage of GDP, Caribbean countries generally exceed the 15 to 20% international benchmark for developing nations. Barbados performs exceptionally well because one of the reasons we have a very large social welfare state, and a lot of Barbadians, for the most part, we're comfortable paying more taxes, bearing in mind we have free healthcare, we have free education, inclusive of tertiary level, subsidized public transportation, etc. So this whole notion about that social contract where the government would get taxes from you as a citizen in return for providing these things, that's one of the reasons why you see these higher levels in Caribbean countries, particularly Barbados. Next slide, please. Caribbean countries are seeing a shift in tax composition, with indirect taxes levied upon goods and services before they reach the customer who pays it as part of the price, comprising a growing share. So this marked rise in the reliance on indirect taxes within the region helps to, of course, broaden the tax base. But they're also regressive and disproportionately burden low-income populations. Next slide, please. Improving compliance is a priority. So I outlined some general observations here. I wouldn't go into all, but just to note that compliance is a priority, but trust in institutions must be strengthened, of course, through greater accountability to ensure higher rates of compliance. And that leads me to another problem, the levels of informality in our economies. The informal economy in the Caribbean, there's not a lot of data, but there have been studies which have shown that it could be as high as a third of the size of the formal economy. And you really saw that during COVID-19, where a lot of businesses were unable to actually get access to some of the grants and other incentives that the governments were providing because they could not show, for instance, business registration, taxes paid, etc. So that is one issue that will make increasing domestic resource mobilization difficult without interventions. Another thing is that tax administrations across the region are, of course, undergoing reforms, digitalization. Barbados, we have our TAMIS system, business facilitation to make it easier for entrepreneurs to register. A few countries have fiscal responsibility rules, but of course, resource constraints mean that you have to increasingly outlay this money in order to update your systems, invest in technical requirements, etc. And of course, there's a panoply of international standards which are constantly changing that our tax authorities have to comply with. And bearing in mind, these are SIDS, so sometimes you might have one person which is responsible for a multiplicity of issues. And then, as I mentioned, data shortages, which is a bugbear for me as an academic and for most academics in the region because there's very little data on some of these things. So with regard to the recommendations for the international community, so the elements paper, I will say, next slide please, sorry. That's quite all right. The elements paper, I would say, was quite comprehensive. It recognizes that the international community can play a pivotal role in addressing the challenges which SIDS face with regard to domestic resource mobilization. So for instance, it talks about promoting inclusive global cooperation, etc. But I think it's important for them to not just give lip service to taking into account the realities and capabilities of countries like SIDS, but actually have greater inputs by SIDS into these things. And that's why the UN tax negotiations are going to be so important, and why, generally speaking, Caribbean countries have been quite on board with regard to the UN-led discussions on international tax cooperation, because it's a more inclusive setting for these kinds of rules. Another, of course, is ensuring that MNCs pay their fair share of taxes. And Barbados, for instance, is already one of the countries which has started to implement the global minimum tax. Bahamas, they had their parliament discussing the bill that was passed. Hold on a minute. And right, providing greater capacity support. So there is capacity support already, but greater support to assist in terms of tax administration, facilitating business, but also to bolster statistical offices' capability, because, you know, we're academics, so we know you cannot have evidence-based policy making if you do not have proper data. If you don't know what's the true size of your informal economy, if you do not know why is it that there are high levels of lack of business registration, etc., why are these things happening? You need the data in order to get to that. Another thing is relooking back listing practices. And I'll spend a little time here, given that I have 3 more minutes to go. A lot of our countries at one point in time have been included on blacklists or gray lists for the purposes not just of tax, but also money laundering. And these practices, not only in many cases are they unfair because they disproportionately target small countries when larger countries are doing it. But another thing is that such practices have adverse developmental impacts. So it makes you less opening, less welcoming for FDI. If a company sees that you're constantly on a blacklist, they're going to be less inclined to want to invest in your country. And FDI, as we know, is an important source of external financing, private external financing for countries. And so my ask is that there's a need for the international community to advocate for fairer criteria and processes for identifying jurisdictions considered non-compliant with international tax standards. So to wrap up, I highlighted the domestic resource challenges faced by Caribbean SIDS. They are significant. There's work being done, but of course, given the issues that my colleague mentioned, there are some challenges that need to be addressed, and with targeted support from the international community, this could help them in terms of strengthening their tax systems, mobilizing resources more effectively, and of course, helping them to achieve financing for the Sustainable Development Goals. Thank you so much, and I look forward to any questions in the Q&A.
Thank you very much, Alicia. We're going to turn now to a presentation from Jose Maria Gomez-Lopez. Jose is a professor at the Higher Institute of Business and Economic Sciences, ISCEE, in Cabo Verde. And over to Jose to talk about debt sustainability in Cabo Verde. Thank you.
Thank you. Good afternoon, everybody. Thank you, Emily, for invitation to be on this panel. And my talk is on breaking the cycle of debt and finance and sustainable development on the perspective of Cabo Verde, that is a SIDS. Well, we know that Cabo Verde has been widely lauded as for its successful development progress since it became independent in 1975. And as it graduated to a middle-income country in 2007, the country started to change the source of financing for its development. Next slide, please. So, as you know, the country had been before 2007, basically financing its development based on ODA. So the transition, as many people said, made Cabo Verde to become a victim of its own success because, as you see, external debt grew substantially after 2007. So the country had to indebt itself to fund its development. And mainly during after 2008, with the financial crisis, FDI reduced substantially, so the country had to indebt itself to finance its development. And next slide, thank you. And not only external debt, but also internal debt grew substantially. And in fact, also, many people say that Cabo Verde became a victim of the middle-income country trap. So total debt, as you see, for instance, in 2021, reached 144%. This is very high in terms of its GDP. And internal debt reached above 40%, so 41.8% of GDP. So both internal and external debt actually are considered beyond to what is called the sustainable threshold. And despite the decreasing trend of debt in the last 2 years, they are still a constraint to sustainable development in Cabo Verde. And how debt is impacting sustainable development. So here, Cabo Verde's high risk of debt distress is limiting its access to external financing, according to some research. And debt servicing is heavily impacting state spending, as you can see, as it squeezes out resources for some of the key sectors. Just one example, in 2022, about 210.5 million USD was spent on debt servicing compared to 108.3 on education, 77 million on health, and almost 11 million on environmental protection. And as debt services overtake investment in key sectors, the question is how the government guarantees the availability of appropriate funds to finance development. As you can see here, until 2030, Cape Verde will need annually around 163 million annually to finance its sustainable development. Just one example, you see education, energy, and productivity infrastructure are some of the key sectors that the government will have to mobilize funds so that they can invest in these sectors. And there's a financing gap of 103 million USD annually to finance development. So what this graph shows that the spending on debt servicing and the constraints to access finance is widening the gap, to promote sustainable development. And also, next slide, please. We can see here one example regarding the cost of climate finance needs. So there's an estimated cost of around 2.3 billion USD, being 213 million annually, that the country needs to mobilize to invest in adaptation and resilience, mitigation, and also loss and damage. And there's still a climate finance gap of around $120.3 million annually until 2030. And this amount is very high, as you can see, is around 4.2% of the country's GDP. So the question is, next slide, please, what strategies the country should engage to prevent that distress and close these finance gaps? Well, there are four major policy strategies that Cape Verde is expected to undertake. So first is the fiscal revenue, as Alicia pointed out. So the country is obliged to mobilize internal funds. And this is done through tax, the extension of tax base, and also, and this extension is made mainly through the formalization of business. We have a large informal sector, so the government is investing and needs to invest more in the formalization of the business to broaden the tax base. And another point is there's a need for a better rationalization or even elimination in some tax incentives for foreign investors. As you can see there, tax waivers made up 22% of tax revenues in 2022. And there's a discussion about the benefits that these incentives are generating to the economy. So the second point is the prioritization of structural investment. So the government, in collaboration with its partners, should identify the key sectors to invest. And some of these areas include renewable energy, human capital development, economic diversification, island connectivity, and also digital transformation. And thirdly, there's a need to redirect remittances from consumption to investment in these key sectors. And finally, there should be alternative finance mobilization mechanisms, strengthening the national capital markets and diversification of sources of finance, especially from the private sector. And also, there's a big discussion in Cape Verde, and some of these mechanisms have been tried, which is the sustainability bonds, including the blue bonds, the green bonds, and the social bonds, and now the diaspora bonds. And finally is what commitment the international community should undergo to support Cape Verde and SIDS. There's a need. So there are 6 points that I would like to highlight here. And these recommendations come, in our research on that sustainability that we did, coordinated a study that was coordinated by Dr. Gale. So there's a need to review concessional financing criteria. As it has been mentioned here, GNI per capita doesn't fit anymore, so Matt also talked about the MVI that should be taken into account. So the second one is debt maturity. So there's a need to extend repayment terms at no additional cost, mainly when environmental or natural disasters require significant financial resources for state responses. And also the issue of responsible lending. We are talking about lending, but easing access to finance for SIDS, Cape Verde in particular, should not equate to lending at all costs. So responsible lending is the key. And fourthly, there's a need to ensure that mechanisms are in place to assess investments, and this mechanism should be aligned with the key stakeholders' interest, with the clear outputs, objectives, and expected returns. And the next point is very important, which is about the autonomy for resource exploration. So Cape Verde's other SIDS should have a great autonomy and the capacity to explore their, mainly the marine and natural resources. And finally, the innovative financing solutions. Cape Verde's other SIDS need to explore innovative financing. I have mentioned some to diversify their sources while also ensuring affordability. So options includes seed stock exchange platforms and supranational banks or investment funds dedicated to seeds. Well, we know that national governments in seeds, in Cape Verde in particular, their efforts, they should keep doing efforts to raise not only internal finance, also external finance, but their efforts will not bear fruit if international communities do not recognize their special case and make funds available for them to promote their sustainable development. Thank you.
Thank you very much, Jose. And I think it's really a very instructive and interesting example of a small island developing state really doing a lot to try and manage debt sustainably and grow and invest in resilience. We're going to turn now to back to Gail to continue the discussion around debt sustainability from a more sort of global SIDS perspective. Thanks.
Thank you, Emily, and thank you to all my colleagues. I think their presentations very much set the scene for my presentation. So as Jose introduced, at RESI we've been, over the last year or so, looking at the causes and consequences of high debt in small island developing states and what can be done to break the cycle of debt. I was lucky enough to work with Jose on the Cabo Verde case study. We looked at 5 other countries. I think our colleagues are here from Jamaica. That was one of our other case studies. So a warm welcome to you. The other piece of work we've been looking at, and what I'll present today as well, is on the cost of borrowing in SIDS and what can be done to lower that, and what can we put forward in terms of proposals for that for the FfD4 negotiations. Because I think we see very clearly from our work that the international financial architecture is not working for SIDS. It's not delivering for them, so we definitely need to see change, and FfD4 provides an opportunity, in our view, to deliver that change if there's ambitious messaging in there and commitments for SIDS. Okay, so next slide, please. Okay, so what did we find from our research? And I'll try to go through this really quickly. So from our research, it comes as no surprise to many of you. For many SIDS, high debt has been a persistent and unresolved issue for many years. Why is this the case? Matt has already mentioned one important factor. He talked about how many SIDS are excluded from ODA and concessional finance. Here, the numbers really show just how far they are excluded from concessional finance. In 2022, SIDS received just 1% of the total ODA envelope, which is really quite pathetic. A second challenge is that SIDS are subject to multiple and repeated external shocks of all kinds. And as you can see from the table here, large and rapid increases in debt are directly attributable to these shocks, particularly climate-related shocks. And I think, again, the figures there speak for themselves, that just several years after a shock, you can see debt ratios really rise quite exponentially. And I think it seems like an obvious point, but it is one that is often overlooked and that we feel very strongly at RESI that we need to keep hammering home, is that what this means in practice is that SIDS are not borrowing to advance sustainable development, but they are borrowing to recover previous development levels. And it means that shocks mean that many SIDS are locked in a continuous cycle of shocks, then recovery, then shocks, then recovery. And obviously with the predicted impacts of climate change and the current impacts of climate change, this is only projected to worsen over time. And then finally, we also see the shift towards non-concessional forms of debt. We find that in part due to the lack of concessional flows, that SIDS are borrowing heavily on non-concessional terms, both from domestic and external markets. Non-concessional debt now makes up about 45% of SIDS' external debt portfolios, and because this debt is more expensive than official debt, the debt service burden of that is also much higher. And as the chart here shows on the bottom right there, it just shows how much debt service commercial creditors are eating up and how much that is projected to increase over the next few years. And in the paper, we have what that looks like for individual countries, and it's really quite shocking in some cases. So high debt, what are the consequences of that? We looked at the causes. What are the consequences of that? High debt and high debt service locks countries into cycles of low investment, low growth. We compared spending in education, health, and capital investment in SIDS with those in high-income countries over the last few years. And as you can see, SIDS spend less, often far less, than high-income countries in areas like education, health, and capital investment, even though their needs are often much higher. And we think that's a pity, because as Emily mentioned in her opening remarks, our research on debt in SIDS shows that on the whole, debt has been well used. It is not. It is simply not true that there's been irresponsible, profligate borrowing by SIDS. The case study from Cabo Verde showed very clearly, others too, that debt has been well used to fund infrastructure, investment, resilience, and disaster recovery. So the fact that this borrowing is crowding out investments in these areas is really a pity. Okay, so SIDS, the high cost of capital. So this shift towards commercial capital is really problematic for SIDS because they have a very high cost of borrowing compared to advanced economies. So we looked at the average cost of borrowing for SIDS on international bond markets compared to developed countries, specifically the G7, over the last 20 years. And we saw that on average, SIDS are paying over 7% on bonds issued in 2023 compared to about 3% for G7 economies. And even if you take a longer time period, interest rates have been very, very low between 2015 and 2020. G7 economies benefited from interest rates often below 1% on their bond issuances over that period. For SIDS, it still remained over 6% over that time period. So we ask, does the high cost of capital for SIDS, is it justified? And is it actually creating a self-fulfilling prophecy where prophecy, where high interest can actually push sovereigns to default. And we see that in the case of Suriname, which we look at in our paper, which has had borrowing costs of over 9%. And in fact, some of its bonds were recently issued at over 12%. And the Maldives has been in a really difficult position recently as well. And again, it has a very high cost of borrowing, issuing bonds at over 9% as well recently. So is there a SIDS risk premium? And is the higher cost of borrowing justified? And we say no. In our paper, we show how SIDS, even those with no history of sovereign debt default, are still punished. So that would be the case of the Bahamas, for instance, still borrowing well above 7%, zero history of sovereign default on its international bonds. Countries that have invested heavily in responsible and prudent debt management over recent years, and Jamaica, that would be an example there, is still not rewarded with low borrowing costs. We also find that credit ratings agencies still very much rely on sort of the traditional debt and fiscal metrics and do not take into account things like how investments in resilience might improve a country's economic outlook, or crucially, how the international community has actually rolled out over recent years a whole suite of contingent and emergency financing instruments and response mechanisms, particularly the multilateral development banks have rolled out various contingent financing facilities designed to help countries cope with shocks and crises. We've seen the rollout of climate-resilient debt clauses to support countries when they experience a major shock to temporarily pause debt service. Various sovereign risk insurance products have been rolled out in the Caribbean and the Pacific. You would all think that these would help to improve a sovereign's outlook. Are they taken into account? Absolutely not, is what we are finding, suggesting that investors are making unjustified excess returns in our view. So we, next slide, thank you. So we think the current situation robs countries of much-needed investment capital. So we wanted to find out, actually, to make this a very compelling argument about how much this is robbing countries of much-needed investment capital, what actually would happen if we lowered borrowing costs to those equivalent to those of G7 nations. So we looked at the US dollar-denominated bonds issued on international debt markets by 10 SIDS between 2003 and 2023 and asked how much could be freed up if their borrowing costs were on a par with those G7 countries on average over that same time period. So we find on about 36 billion in bonds issued over that period, SIDS are projected to pay about 7.87 billion in interest and principal repayments over the lifetimes of those bonds. If they'd borrowed at the same rate as G7 countries, they would have this would be lowered to about 49 billion, meaning that almost 34 billion could be freed up through lower borrowing costs for investment in the SDGs. That is substantial for small economies, and in the paper we show what that actually looks like for individual, those 10 individual countries. Okay, so what needs to be done? So a more responsive international financial architecture for SIDS is clearly needed, but what could be some of its core features and what can be taken forward at FfD4? So I saw in the Elements paper that they do mention innovations like the climate-resilient debt clauses, catastrophe bonds, debt swaps, and so on as being important. But I think that, well, we think that there's a strong justification for the FfD4 outcome to be more ambitious. So things that we will be proposing include more guarantees to help lower the cost of borrowing for SIDS, so a SIDS-specific guarantee mechanism. MEGA, the World Bank's multilateral investment guarantee facility, has just announced a small states guarantee facility. This is something that could perhaps be rolled out by other development partners. Going above and beyond climate-resilient debt clauses. So they temporarily pause debt service in the event of a major shock, but in many ways just kick the can further down the road. But if you have an automatic debt service cancellation mechanism that writes off that debt in the event of a qualifying major shock, that would be much more meaningful and could actually help to increase SIDS credit worthiness as well, which would be important for future borrowing costs. And I think Matthew's been doing some work modelling what that could look like for SIDS. When it comes to sovereign credit ratings, what we find is, because it's a small market, they don't necessarily bother to invest in understanding SIDS very well. So, more expertise on SIDS, and crucially making sure that SIDS have more voice and representation in the international regulatory bodies that govern credit ratings agencies to help ensure there's a more fair and accountable system. And then the need for improved methodologies when it comes to assessing creditworthiness. So factoring in things like investments in resilience and what I was talking about, this wider suite of tools now available, of course they do help to improve SIDS creditworthiness. That's not to say any of this absolves the international community from providing more grant financing for SIDS. It is really needed and is a matter of climate justice. It's about having a package of measures together that will work better for SIDS. So some suggestions on the table for those of you who are working on the SIDS, on the FfD4 outcome document, and very happy to answer any questions you might have. Thanks.
Thank you very much, Gail. So there's one final presentation from me. I will try and be quick so we have some time for Q&A at the end. I'm going to talk about climate finance and the challenges that SIDS face in accessing climate finance. The reason why we're including this in the sort of overall panel discussion is because you would have thought that this would be a really important source of financing for SIDS, given that climate finance, and particularly the vertical climate funds, don't have those restrictions, and all SIDS are eligible, and so really ought to be a very important source of financing for climate resilient development. But there are a number of challenges. SIDS are one of the priority groups for the GCF and other funds alongside African states and LDCs, but they do struggle to access funding from GCF and other funds, and you can see on that chart that the total proportion of funding allocated to SIDS is about 12% of GCF funding. So for one of the priority groups, that's pretty low. And then, of course, there is the challenge of co-finance, which I'll talk about a little bit more in a minute. So volumes of finance going to SIDS are low even within the GCF, where it's one of the priority groups. I wanted just to sort of look a bit more broadly at finance flows to SIDS, not just through the vertical climate funds, but more broadly what we call resilience finance flows. So that's anything really from climate and development finance that's aimed at strengthening resilience. You can see from these charts that the levels of resilience finance for SIDS per capita are high. But I think what we really want to underscore here, and this is very important for sort of comparisons with other groups of countries and for thinking about why SIDS face particular challenges, is because the fact that there are tiny populations and a small denominator means that, of course, there's going to be higher levels of per capita finance than for other groups of countries. So that's a misleading comparison. There's two other charts here. One is the total amount of finance. You can see the volumes going to SIDS are very, very small, but even as a percentage of GDP, significantly lower levels of resilience finance than for LDCs. And similar to low middle income countries. So just want to sort of give a sense of how the metrics change or the levels of finance change depending on sort of how we count it. And I think that's important in thinking about discussions more broadly around development, access to development finance as well. We conducted a survey with a quite large group of SIDS on their experiences of accessing funding from the GCF, and were really struck by the results. I mean, there had been an independent evaluation that had already identified some of the bureaucratic processes as being problematic, lengthy, inconsistent, and non-transparent, said the evaluation unit, independent evaluation unit. But in addition to that, there's the sort of real-world problem that if the funding approvals take a long time, it's very difficult to make predictable decisions about and implement climate finance, which is very challenging. So, by the time you get the finance, perhaps the priorities have changed. Another major issue that SIDS had to deal with was this sort of providing a climate rationale to demonstrate that the impact is that they want to address through the project is related to climate change. This is really sort of unduly onerous, given that actually all sort of development in SIDS needs to be climate resilient, so it's all related to climate change, really. It's hard to think of an example that wouldn't be. And just to share with you some of the survey results, 30% of SIDS projects that were reported on have been in the pipeline for more than 3 years. That is a very, very long time. And nearly half of all projects for more than 2 years. And the respondents were basically talking about technical requirements as being difficult or extremely difficult. So you're getting a picture here of a process that is really very, very challenging for SIDS and other countries, particularly LDCs as well, in accessing a fund which is supposed to be for them to deal with the sort of challenges which they are developing projects to address. So these are major challenges. The challenges that they're facing are representative of sort of broader bias in climate finance and climate funding, and we see this bias as sort of having two strands. One is sort of an increasing financialization of climate funding, which is premised on the idea of this finite global public funding being available, so therefore needs to be used to leverage or mobilize private sector funding. That's very challenging. Mobilising co-financing is very challenging, particularly for adaptation projects, and penalises small countries that have high levels of debt, small economies. So that's a real challenge, and we saw in the project, the feedback on project proposals are often comments in relation to the projects should be seeking to leverage private sector finance, which is really challenging, even for mitigation projects in SIDS, because it's not clear that there's going to be a revenue stream from those and economies of scale. The second bias, and perhaps even more important really for SIDS, is the sort of bias towards scale. In the project proposals and the way they're evaluated, you can see very clearly that sort of the bigger projects are better. They are associated with economies of scale and scope. And these large projects are viewed as more efficient. They're reaching larger numbers of people. These beneficiary metrics are really important to the GCF and to other funds. And the project approval process is similar even for smaller projects. So the challenges that SIDS are facing with smaller projects should be lesser than for larger projects. But we don't see that even with a simplified approval process. So a clear sort of set of biases that kind of inbuilt into the GCF and to other funds which need to be overcome, I think, rather than just focusing on, and where a lot of development assistance has gone, to building the capacity of SIDS to access these funds. I think that as a response is problematic, because actually it's the difficulties or the challenge comes from the funds themselves and not the lack of capacities in SIDS, if that makes sense. So some recommendations for the GCF, which we put to the GCF last year, but I think apply to broader issues around accessing climate and development finance, is that a minimum funding allocation, and this was a proposal of AOSIS in the climate finance goal at COP29, to have a sort of minimum funding allocation for SIDS and LDCs would help to incentivise the funds, in this case the GCF, to ensure that these vulnerable countries are getting their fair share of climate finance. And it would help reduce uncertainty, that countries would know in any given year how much finance they're going to get as a minimum to implement, and help them to take a more programmatic approach to implementing climate projects. Another recommendation was to introduce a physical presence in regions and decentralised programming and decision making to ensure that there's more staff who have a sort of lived experience or an understanding of SIDS context when taking decisions, when looking at and appraising projects. And then there were a set of recommendations around reforms to the Secretariat to improve geographical balance and culture to better understand SIDS context. So while these are recommendations for the GCF, I think they are the sort of recommendations around governance reforms and things that need to be taken into account in other development funds, and thinking more broadly about development finance, which would help to ensure that some of these very specific issues that we've been talking about, very specific structural vulnerabilities and challenges that SIDS face, are well recognised and understood, and really part of the response that comes from the international financial institutions. So I'll leave it there. We have got a bit of time now for 10 minutes for Q&A. So I open the floor. Anybody has any questions or comments on any of the presentations, please just raise a hand and introduce yourself, and over to you.
To zero in on the particular recommendations from Ms. Hurley, and regarding the cost of financing for SIDS versus that of G7. I wanted to know if, especially in relation to rating agencies and their the ratings that they assign to sovereigns in our region or in SIDS, was any analysis done on growth trajectories in these sovereigns? Because what I find is that the rating agencies very often, they use the excuse of weak growth trajectory. I mean, for example, in Jamaica, they say that, oh, you're doing very well. They'll probably just revise the outlook or just push it up a notch or so. But they keep saying that the growth trajectory is very low. So I think probably in engaging them, we need to probably find out why so much focus is placed on the growth trajectory in our country. My second comment would be, or question, would be on Mr. Lopez's presentation, because you mentioned, I don't know if Cabo Verde is a market access country and if they engage rating agencies. But you mentioned one particular recommendation regarding extension of maturity, debt maturity, and repayment terms. How would rating agencies view that particular recommendation? Because I think that some of them would actually, once you extend your debt maturity period, they would actually view it as some sort of default, and then, downgrade, and you know what that means for credit and all of that. So I just wanted to know if, consideration was given to those factors. Thank you very much.
Well, thank you, Ms. Black. I think what we see is that the credit ratings agencies are very conservative in their methodologies and tend to just follow each other rather than do anything new or different. So you're absolutely right. They suggest there's a poor prospects for economic growth over the next few years, but actually don't bother to think about or look at whether certain investments in growth that debt might be used for could actually be growth enhancing and resilience building, which I think is a real gap. But I mean, there's a lot of opaqueness that we found with regard to the methodologies. They would say that they've become more transparent, and there is information on their websites about what debt and fiscal indicators they do look at. But in terms of actually understanding what weighting they're giving more subjective measures like political risk and governance, I think is a challenge as well. And I think from the conversations that we've had with some experts, there's not a lot of expertise on SIDS. They actually can't be bothered to invest in learning and understanding more about them because they do represent such a small market share. So I think that is problematic. And something that needs to be addressed in terms of not just more transparency in the methodologies, but how can we actually create a fairer and more representative credit rating systems. And I think here the issue about voice and representation of SIDS is important.
Thank you. Thank you. Thank you for the question. Yes, the last rating by Standard & Poor classified Cape Verde as B, and that is one of the elements that they take into consideration. As I said in my presentation, public debt now stands at around 117%. For that is the estimate for this year. We don't have the report yet, and surely debt maturity is something that is a concern. Well, Cape Verde has never defaulted, but its high proportion of debt to GDP has been a concern for international donors. And recently, mainly because of COVID, the government has to increase the internal debt. That also was and is still a concern for our partners and even for national stakeholders. The issue of crowding out is a concern in Cape Verde, and some business chambers are even arguing that internal debt is crowding out some credits that private are not having access due to that. So the maturity in terms of extending, so that raised the issue of the country's capability of serving its debt, its responsibilities. Yes, it's a concern. It's an issue that the credit raters usually take into account. Thank you.
I think so then Matt can hear you.
Okay, all right, I'm just going to see it else. Again, for a very good discussion and for all the documents that support this conversation around financing for SIDS. I just wanted to mention that through the Pact for the Future, the UN received a mandate to start seriously addressing issues pertaining to debt and debt management, including the aspect of credit rating. Obviously, creditors are investor biased. They would not necessarily, as Gail just mentioned, spend much time to understand what exactly the parameters of SIDS economies are making them safe to continue to borrow. In that regard, SIDS established this Debt Sustainability Support Service. There is a meeting also this week to address aspects pertaining to that management and primarily credit rating. Only 13 of the SIDS actually have credit rating, and credit ratings are very poor in general. One aspect that came up into the conversation was the use of the multidimensional vulnerability index. SIDS would like the MVI to be guiding credit rating agencies to better understand the context, and that would not be for SIDS alone, obviously, but this is a conversation that took place into the Debt Sustainability Support Service meetings. So credit rating agencies would need to have a better understanding of the context, and that's primarily where the MVI could help, and the vulnerability and resilience country profiles as soon as these frameworks will be used by member states and by SIDS, by just indicating why certain investments are needed to offset the impact of those structural features on the economies of SIDS. Of course, SIDS' growth rate is low. It's a circle of implications here. Since they can't borrow, how are they going to grow? They, as mentioned in many of our meetings, they underspend because they are unable to borrow. And those are very serious issues. So obviously, helping credit rating agencies better understand what holds back growth and why certain investments for which SIDS need to borrow are going to strengthen their resilience would be a great step forward. And that's a joint effort that we need to make. Obviously, ODI is playing an important role in keeping the lights on this particular topic. And within this Debt Sustainability Support Service that SIDS established, that conversation could actually lead to more visibility at the G20, for instance, and in some other parts of the world where the reform of the financial architecture is being discussed at this point in time. But the MVI is an important parameter. That's practically why the SIDS have pushed for it for such a long time. And now as a universal metric, it would be extremely informative to financial institutions, credit rating agencies as well, to help make that more affordable and more accessible, as that is a development finance instrument. That is not the result of poor policy. That is actually how countries develop, and it needs to be affordable for SIDS alone. Thank you so much.
Thank you. Thanks a lot, Simona. And I do think that point about making debt more affordable could have been stronger in the elements paper, and hopefully that's something to take forward into discussions. Yeah, I think we can take one more question. Go.
Gail referred to the work we've been doing on looking at how much you could actually cancel SIDS debt service for 5 years after they were hit by a disaster. And it would cost something like $1.9 billion a year across every single SID to cancel all of their external debt service for 5 years after a disaster event, which is frankly peanuts by international standards. So I think it should be an idea whose time has come. Two quick suggestions for the papers. One is I'd like to, and I think the work is fantastic and I agree with every single recommendation you've got in there, but one is I think we need a bit more negative on things that have been suggested as solutions that haven't worked. And I put into that, I'm sorry to say, debt conversions, CRDCs, insurance. They have worked a bit, but the costs that they involve often can be even more than the savings that they bring. So let's be honest about those, because otherwise I think we risk having in FFD just people reiterating on these wonderful, let's do more of them, which really won't solve the problem. And then secondly, on credit rating agencies, I was just in Geneva last week at a meeting of UNCTAD's Intergovernmental Expert Group where they focused on credit rating agencies. And I think one of the conclusions we reached, well, two quick conclusions we reached. One was, it's not just the agencies. So what we noticed, drawing on a lot of work that's been done on Africa, is that there isn't much less of a clear link between the rating you get and the price of your bond than there was 15 or 20 years ago. And that actually a lot of the problem is with bond issuers or the people who give advice to SIDS and other countries on what price to issue their bonds at. So you have bonds being issued at ridiculously high prices and therefore oversubscribed on the basis that you're not known in international markets. So look at that and look at whether we need the broader regulation of how the issuers work. But also, I think that fundamentally the conclusion we reached, we had a meeting of something called the Borrower Caucus, which UNCTAD has set up. And what we were talking about there was what should countries do for themselves? And my view increasingly is that countries should do what places like Rwanda and Ethiopia and some more developed sort of bigger countries have done over the years, which is just to issue bonds at a reasonable fixed price that you think makes sense, 1 or 2% above your inflation rate or whatever it may be, and not to rely on the advice of these issuers who might be completely skewing your market. So I think trying to find things that you can actually do without waiting for FFD to solve your problems is probably a very good solution, and maybe exchanging information among yourselves as SIDS to actually know what prices you should be issuing at and how to deal with the issuers and the credit rating agencies would be good.
Thank you. That's really useful. I don't know if there's any other. Anthony, yeah.
And I just have a pretty basic question. My name's Tony. I'm from Australia, Department of Foreign Affairs and Trade. We obviously have a very keen interest in how this unfolds, FFD unfolds, particularly from a Pacific SIDS perspective. But more broadly, just looking at the elements paper, I guess our initial assessment is that it doesn't have a particularly strong focus on SIDS. I think just what Matt was talking about, this universality of taking these ideas forward that originated with SIDS, for example, with the Debt Suspension Support Service that came from OASIS, and then the way that's represented in the elements paper is about applying it beyond. And so just wondering about how we can try to keep the focus on SIDS a bit better than perhaps is reflected so far in this process. Just any suggestions you have. I know we've talked about the MVI, but the MVI doesn't really apply to the IFIs. So, how do we think about that? I think we've had some success, for example, with the Asian Development Bank in our region, with the ADF, the concessional arm, being able to bring a lot more focus into SIDS in that particular case of the last replenishment. But just looking at beyond and your experiences, just any ideas that you have just to be able to keep the focus on. Thanks.
Thanks. If I might respond first and see if colleagues want to jump in. I mean, I do think it's useful to talk about the special circumstances and the focus and need for SIDS and LDCs to invest in adaptation and resilience, and therefore the need for highly concessional finance, grant and highly concessional finance for those activities, and to differentiate when we're talking about increasing volumes of finance, what it's for, and therefore what kind of finance is needed, the quality of finance. And I think that's one way of talking about SIDS in a very specific sense. I think it probably won't go into the outcome document, but the idea of having a minimum funding floor is a very good idea, because then it it focuses the attention and provides an incentive to ensure that the financing gets there. Could have similar language around debt sustainability as well, particularly calling out the needs of SIDS, not just for increased liquidity when there's a crisis, but to support kind of longer term debt sustainability. So I think the narrative around why in some cases for SIDS it's different, and therefore the financing needs and the assistance that's needed being also different is really important. Otherwise, we're mixing oranges and apples constantly, and I could see that quite a bit in discussions around climate finance. So I think we need to learn lessons from that negotiations process and take them forward into the FfD4 process. Anybody else?
I don't know, Matt, did you want to come in on MVI, maybe?
Well, I could do a little bit. I mean, there's not much to add, really. I mean, I was sat in that very room, I think, a few weeks ago at a UNDESA session on this question, and it seems to me that there is a huge tension that SIDS face. On the one hand, justifying the distinctiveness of their situation, which personally I think is distinctive, right? They are exceptionally more vulnerable than most other states, and they do face a range of constraints and shocks that others don't. But obviously the position of different SIDS groupings is quite different as well, right? So the Pacific countries, by and large, tend to have access to more concessional resources and considerably more concessional resources in some cases, but their particular patterns of vulnerability are different to those in the Caribbean. They also have a different relationship with their main donors, I think, than the Caribbean countries do. And it's different again, I think, when you look at other regions like the Indian Ocean and elsewhere. But it seems to me that one element of this challenge is thinking about the advocacy strategies that SIDS have to push forward. So on the one hand, there's this other tension between gaining buy-in for their agendas whilst also kind of rendering them meaningful, because they are small and, you know, they've achieved a huge amount in terms of getting a lot of these issues onto the agenda, but also struggle to turn them into, you know, actual concrete resources. But for me, a key part of that advocacy strategy has to be about asking the question, you know, if you agree that we have a special case for sustainable development, where is the special treatment? Because it isn't a special case if there isn't some kind of special treatment that is mobilised to give it effect. And I don't know what the answer is, but that's the question I would want to keep posing. I don't know if that's helpful at all. I know there's not much practical there, so I apologise.
Thank you, Matt. And so then, yeah, it would be great to see that across the outcome document. What is the special treatment for SIDS when it comes to access to finance, debt sustainability, trade, and all of the other issues that are in the FfD4 document? I think we need to close there. Thank you very much for letting us continue a bit beyond our time, but that was really great to have some questions and discussion at the end. I hope you found the session interesting. Thank you very much for attending, and go and have some lunch.